Well, greetings, everybody. A warm welcome to the first session of the Investing Roundtable for 2019, our January session. Coming to you from chilly, extremely chilly, crisp Michigan. My name is Mark Robertson. I am managing partner and founder of Manifest Investing. I'm joined here by my friends, Ken Kavula, renowned investment education guy. He participates in about 19 investment clubs and gives speeches all around the country and basically takes care of a bunch of people trying to help a bunch of people invest effectively. We're also joined by our buddy Cy Lynch out of Atlanta. Same story here. Cy's been an investor for, I don't know, at least 3 decades. And does it top that, Cy?
Individual stocks would be about 34 years.
Fantastic.
And yeah, probably mutual funds be about 4 decades, I guess.
Wow.
So.
Well, Cy is one of the original shareholders of Home Depot, and that's something that still brings a smile to his face among the stories that we hear. And we are joined tonight by our world raconteur, Hugh McManus. In fact, I left the St. Pat's Day hat on him. Hopefully he'll be back with us a few times, including March. But welcome, Hugh.
Thank you. Hello, everyone.
Hugh and I have been teaching together since the early 1990s in a variety of different venues, and he's renowned for some of his flashy, a little bit extraordinary selections that he's made over the years. Let's go ahead and get some of the bookkeeping and legalese out of the way. You guys know the drill here. No investment recommendation whatsoever is intended. This is all about education. It is all about the principles, methods, techniques, and things that we do as part of the Modern Investment Club movement. What we do here tonight will be a demonstration, taking a look at some analysis of a few stocks. We'll do 4 case studies for you tonight, talk about some results, all that kind of stuff. It is all for demonstration purposes only. We will own a few of these stocks, and we'll probably remember to mention it as we go through. If you want to include a friend or family member on the reminder for this list, you can write to nkavula1@comcast.net and ask her to add you to the list. And then, as Ken and Natalie covered last month, there have been some reports of some caching or some type of problems with the GoToMeeting or GoToWebinar software. And if you continue to have problems, or if you're aware of anybody in your clubs or community that are having difficulty, you can call that phone number and actually talk to the software provider. Ken, do we have any more reports or anything of concern that we should talk about?
No, it seems to have quieted down quite a bit, Mark. We're not getting nearly the number of reports we did a month ago, so maybe GoToMeeting has fixed some of the issues as well.
It did sound like they were tackling them pretty head on, so hopefully that's a thing of the past. If you have copies, or if you're bashful and have questions following the session, feel free to send to markr@manifestinvesting.com. That's also the address for Groundhog Challenge, our stock selection contest entries that you'll see mentioned a few times tonight. markr@manifestinvesting.com. Here's our standing agenda. We do this pretty much every month. We start by welcoming everybody back to this month's session. Good to see all of you here. There's people here from all over the country. Quite a few from the mid-Michigan area, but again, we see people from coast to coast. If you're joining us for the first time, an extra big welcome. When it comes to an audience vote at the end of the day, at the end of the session, you're welcome to participate in that, and we'd love to see you back. We'll talk a little bit about market perspectives and how the portfolio has performed over the years. We have been doing this on a monthly basis for 8.5 years now, so we'll be coming up on our 9th year this summer. I never would have dreamt that we would have done this, because you can trace it all the way back to the first session when I asked Ken if he'd be interested in doing this. He said, okay, but no costumes. And and his aversion to that still holds true today. He does allow us to stick some hats on the slides, stuff like that every once in a while, but we will take a look at how we have done over those 8.5 years. We'll take a look at a couple of challenges to the portfolio on the basis of some companies that have done so well that they now have lower return forecast. We'll also look at some companies that are eligible for what we have termed a timeout. just misbehaving a little bit. We call them the rule of 5 misbehaviors. And there are a couple that qualify for that tonight. The 4 stock selections are, as you see there, TJ Maxx from Ken, or TJ Companies, I should say, from Ken. EPAM Systems is a repeat selection by Cy Lynch. He keeps picking that one because he knows we'll ridicule him if he picks Cognizant Technology again. They're similar companies. But EPAM has been a very successful selection over the last couple of years, and he's bringing it back. He's going to go ahead with another Ardelex, ARDX selection. That's a little more speculative pick, a little bit earlier in the company life cycle selection by Hugh. And then I'm going to go with Health Insurance Innovations, HIIQ. There is a poll. You can select from the 4 or none of the above. When we're done, we do try to leave it open for a few minutes. I do encourage my colleagues to be step lively tonight. We have a lot of slides to cover here in a little over an hour that we are together. So let's go ahead and dig into a few things. Just wanted to remind everybody that we've been doing this every month for 8.5 years now. It really is intended to be an opportunity to share and take a look at some of our best investment ideas over the last few years. We do have an objective to beat the Wilshire 5000 by 5 percentage points over the long term, and we'll take a look at how we're doing. We are actually beating it. We also would like to see the majority of our picks actually outperform the general stock market as measured by the Wilshire 5000, and we'll take a look at that also. But what I thought we would spend just a little bit of time, we don't want to spend too much time on this tonight, but because we do have 4 full stock studies to present, is this notion of what you might deem orphans. These are companies that have been selected over the last 8.5 years that failed to be seconded either by the audience that night or brought back as an accumulation selection in the portfolio. So these are one-time selections ranging from TJX up at the top of the chart all the way down to Schlumberger at the bottom. And some of these are just fascinating because as you probably know, or if you don't know, we take and invest $1,000, hypothetical $1,000 into the tracking portfolio every time a decision or a selection is made, either by a guest damsel, or the audience. So you can see the selections that were made here based on whose name is in parentheses on the left, the date that was done. There are only 2 selections among this list of one-time orphans that have actually been closed out or sold in the last several years, and you can see that they did fairly well. They fared pretty well during the holding period. The rest of them are all active selections. And so $1,000 invested into TJX ultimately gained us or became worth $2,338. And then we've talked before about NetEase, ticker symbol NTES, $1,000 becoming $5,300, almost $5,400. What jumps off the chart at you, Ken?
Well, what jumps off the chart is when we were first starting this whole thing, we had a lot of discussions about when we would close something out, and TJX was a great performer, and it was the first stock we ever closed out of the portfolio. We closed it out for par that was approaching money market, but in retrospect, I wish I would have held out for it being at money market before we would have sold it. It's proved to be one wonderful company ever since 2010, and I'm going to bring it back tonight to add back into the portfolio. So we'll take a look at it tonight.
One of the ones I like to look at in the far column on the right, N actually stands for the number of years and holding period, is Costco. We have talked about selling Costco a few times, and Hugh has discouraged it. What are your thoughts on Costco over the years, Hugh? That's one of our oldest selections.
Yeah, I mean, I've always liked the company, still do. Still have a lot of faith that it will continue to perform. The retail space is a bit of a mess right now. That Amazon effect is really butchering people from Nordstrom all the way down to Sears. And but Costco seems to be able to withstand the assault. It's created a very loyal base of consumers. and just seems to perform well.
They just keep trucking along pretty well. And
Yeah.
and Cy, you've got a number on here. Some of them are a little bit more obscure selections that we've seen, like Global Payments and NetEase. What are your thoughts on the value of time? And
Well, time always pays off, or certainly increases the chances of paying off. One thing I would mention about NetEase is I did not, when I saw it on this list, I just glanced at its recent history, but NetEase got hit very hard earlier. Well, let's say this year, January. It was probably about 2 or 3 months ago, partially with some of the Chinese issues and so forth. So it could be much better than that. Global Payments is also an interesting pick, if you will, because that is one that Value Line for a long time just did not like. And as a result, the manifest consensus figures for Global Payments did not look real good. My analysis, I didn't really understand what was going on with Value Line, and so that's I guess a lesson to sometimes trust your judgment over the analysts when you can't fully understand what's going on.
yeah, I think that's a great point. I think Value Line struggles as much as we do with some of the younger or early life cycle companies. You don't have to look any further than companies like Amazon to find that that's true today. I also want to give a shout out to Herb Lemkool, who's joined us here tonight. He's got the number 2 performing selection here. Ionis Pharma is just a few months old, and you can see it's already up 30-some%. And that's against a market that's dropped 6.5%. So kudos to you, Herb. Let's hope that one continues to crunch along, because that's certainly not a household name, and one that we certainly can afford to keep a pretty close eye on. You'll also notice that Kim Butcher makes the green ink here in several different slots along the way, from Formula One to she was on here for something else too. Well, Western Union a long time ago.
Bank of New York Mellon.
Oh, Bank of New York. Yeah, and in fact, that's the one that shows up in the challenge pile tonight as potentially worthy of setting it free and saying thank you. But again, from top to bottom,
I was going to say Ionis is an interesting company because it actually has been around for about 20 years, but it just changed its name about a year ago. It used to be called, believe it or not, ISIS Pharmaceuticals.
Oh, you're talking about Ionis? Okay.
Ionis, yeah.
Decided they needed a name change. It's a very interesting technology, and it's wrapped up technology pretty much in its space.
You're getting beat up on the question box here, Mark, quite a bit about your NVIDIA pick. So I think everybody, these prices are before today, and we did notice, Mark brought it to my attention, that NVIDIA took quite a hit today. So this is only as accurate as a day ago, I think.
Yep.
But yes, we're aware that NVIDIA is going to run down this list quite a bit now.
Yeah, I kind of look at the good report from Apple tonight as being a hopeful moment for all of those companies here shortly. Apple actually reported they beat earnings, and the stock was up 5% after hours. But again, from top to bottom, the way I look at this list is, again, collectively, the work of many people. Never seconded. These are all orphans, but they come in at about an 11% return versus a market cranking away at about a 6% rate of return. So you're looking at a list of decisions. These selections actually have beaten the market collectively by about 5 percentage points, 11 versus 6. So that's a wonderful thing under any condition. And you can see that there's quite a bit more green ink on this slide than red ink. And as Ken has often said, there are a number of times when we probably should be going back and doubling down on some of these type of companies. And we have been doing a pretty good job of that here in recent years. It's just fascinating to see some of these contribute so mightily to the portfolio with only a one-time selection.
Mark, we're getting a really interesting factoid from Marie Bolster. Marie just wants you to know that she went to Costco's annual meeting this week, and she brought back the fact that in 2018 they sold 91 million hot rotisserie chickens and 143 million hot dogs.
Excellent. Well, I don't want to even think about how many of those I've contributed over the years in my family. It works. All right.
I have a hand in the air, Mark. I'm going to unmute Phil. Phil, you're unmuted. Did you have a question? Okay, maybe that's an inadvertent hand. I'm going to take it down. And carry on, Mr. Robertson.
Okay, let's go ahead and press on a little bit. Here is the roundtable performance, just to underscore how well we have been doing. This is the rate of return on the entire tracking portfolio. Again, 8.5 years. We are now beating the market by, 6.7 percentage points. Again, our target was to get to 5. We'd like to get to 5 and stay above it, and we have been doing that pretty well. So the relative return is 6.7. That's simply the difference between the rate of return for the decisions that we've made versus the Wilshire using mirroring investments or matching investments in each one of them, coming in at about 10% over that 8.5 years. So again, in that 6 to 7% range, just wonderful stuff. And we are at a point now where 53.3% of the decisions or selections that have been made have actually outperformed matching investments in the Wilshire 5000. So I think we have to give ourselves a cyber pat on the back and a standing ovation to everybody involved in this. And it's been a lot of fun. Let's hope we can continue cranking away. Any thoughts or questions, Ken?
I think that we should be moving on. We have a lot to do tonight.
We do. All right, here's how you can get to the tracking portfolio. It is a public dashboard, just manifestinvesting.com/dashboard/public/round-table. The legend that you see below that is the number of times that anything has been selected. You heard me teasing Cy about Cognizant Technology a few minutes ago. That's been chosen 15 times. That means Cognizant has been invested, $15,000 has been invested in Cognizant. It is now worth $24,000. So pretty good job. Most of those selections actually are Cy's. I think at least 12 of the 15 selections have come from Cy over the years. But as you walk down the list, again, these are just the top 20 portfolios. There's about 80 active holdings in the portfolio. You can look at the entire portfolio by going to that link. But really strong performance from companies up at the top. Since Hugh's with us tonight, we'll again celebrate Amazon a little bit. That's not an orphan, a one-time selection, but it's a two-time selection that is now worth almost $11,000. So that one is actually one of the top performing selections. And companies like Universal Display, I believe that's a 3, it might be a 5-time selection now, has done quite well, even though the price has been cut in half in the last year or so. But from top to bottom, quite a few household names and a few not quite so household names, a little bit off the radar, contributing to the strong performance. Any thoughts on any of these, Ken?
I'm looking at a stock that just got hammered 2 or 3 days ago. If any of you own ResMed, you know what I'm talking about. It took a drop of, at one point during the day, it was down almost 20% after earnings. But I'm looking at our long-term investment. ResMed's a 2-time pick. It's worth $7,000 after a huge drop. So, that's still a pretty decent return, even though it was a lot higher just a week ago.
Any thoughts from Cy or Hugh on any of the top 20? Again, this is by percent of total assets, so the top 20.
And they're all chugging away well.
And you were able to resist Cognizant again tonight because I know it's looking pretty good.
That's right. Well, I was going for a semi-orphan, as everyone will hear when we get to EPAM.
He's going to push it onto this list, right, Cy?
There you go.
All right, let's go ahead and Ken, why don't you go ahead and discuss the overall portfolio? This is just to give a little bit of reinforcement to what we've been through here in the last month. Last quarter, but specifically the end of December was a nightmare again. And in the last quarter of 2018, we saw stock prices tumble. Hence that blue bar on the right that you see there. That's the median return. Think of it as the average return on about 2,400 stocks that we track at Manifest Investing. That had actually shot up at a rate almost faster than anything we've seen in quite some time because of the negative downward turbulence in the market in October and December. And lo and behold, we've had a pretty good snapback. This little snapback, and then you can see what's happened to the return forecast. It's actually sagged back a little bit. So the return forecast has returned basically to about the 10 level, somewhere in the upper nines. And hopefully we're on our way to good things going forward. So with that, Ken, here's the report card if you want to kind of give us a quick synopsis.
Yeah, this is our portfolio, and there's that MyPar number up at the upper left-hand corner. Mark indicated upper nines, 9.4%. That's the return on the average stock. We're looking to hit the sweet spot, so we're looking to beat the market by somewhere between 5 and 10 points. It's based on the idea that we'd like to beat the market by 5, and you don't often beat the market by more than 10. Nicholson counseled not to be greedy, as do many of the old hands on Wall Street. Don't be greedy in what you're looking for. So we're looking to make 5 to 10. We're at 12.4 in the portfolio going forward right now. That's 3 points above MyPar. That's good, but I'd like to see it a little bit higher if we possibly could. The quality is wonderful. I think here's one reason why our par value is a little bit low. Our sales growth is a little bit low. Mr. Nicholson indicated that really if you're going to beat the market by 5 points, you'd like on an average year, you'd like that sales growth to be up around 11.5, 12% or somewhere in that range. So we could stand to move that up just a little bit if we had the opportunity, and that means that you have to buy companies that have potential sales growth above 10.9 if you're going to move that number up. I move way down to the bottom, the financial strength and stability. I set targets of 80 for these two, so financial strength, which I think is extremely important, is right on target, and EPS stability might be a little bit low. That just means that the blue line's not as straight as maybe it could be on some of our stocks, but 73 is still a good, respectable number. All in all, if we could focus on sales growth on the companies we're choosing for the portfolio, I think in the long run that would raise the par for the portfolio as well.
Okay, and just real briefly, just to make sure that we don't have any one sector zooming out of control. Again, we don't obsess on it. We just kind of watch. There's 5 major sectors represented. They're all distributed pretty evenly. No, you don't have to have one in every one. You certainly don't have to market weight your portfolios. You can see that technology, consumer discretionary, healthcare, industrials, and financials have dominated our selections, at least the ones that are surviving in the tracking portfolio as of now. And that size diversification or size distribution pie is about perfect. You've got a pretty good number of workhorses down that green. Those are basically medium-sized companies. The blue are the faster or slower growing large caps, and the red, you want it to be about 25 to 33% of your portfolio. And that's just a pretty good looking pie chart. So the distribution's okay. I'm with Ken though. If we get a chance to dismiss slower growing companies and add more rapidly growing companies to the portfolio, we do want to do that and never stop. Well, here's our challenges for tonight. And again, we take them in 2 steps, and we didn't have any quality violations. That would be a third. There's none that fit that mode here tonight. So we're basically looking for companies where their return forecast, their par or projected annual return, according to the consensus that is available at Manifest Investing anyhow, are any of these approaching money market rates or are significantly below MyPar, which is at 9.4%. And the three bottom ones, again, these are not terrible. The only thing I would point out is that they are relatively low single digits, and they do have some of the weaker characteristics when it comes to earning stability or quality in these three. Again, there's nothing wrong with these three companies, but they are the three weakest in the portfolio. And again, if we're trying to get more growth in the portfolio, maybe these three do come under a little bit of fire. We could thank them for a successful run and move on. So those are three candidates based on the return forecast being relatively low. Now, we've done a lot of weeding and trimming of the portfolio, so those numbers are relatively high. Any thoughts on those three companies, gentlemen?
I think it's
go on, Hugh. Yeah. Hugh, you need to repeat that again, please.
Well, I was going to say if it helps the overall portfolio, because obviously that's an important goal, then consider letting go of Bank of America. I think it will continue to grow, particularly as interest rates go up. But probably, the growth spurt that it enjoyed from March, April of 2009 through today is it's not likely to repeat that. It certainly won't, actually, for many, many decades.
Yeah, the recovery's been pretty strong, no doubt about it.
Yeah.
And
it'll continue to do well, and its quality will tighten up. Balance sheet, that'll just all happen to all. That'll happen to all banks.
I like the idea, Mark, that this represents about 5% of the portfolio, these three stocks. And I like the idea that we're saying goodbye to three stocks that have done very well for us and whose growth has moved into mid-single digits right now. If we're trying to aim at 11.5, 12% sales growth, it will help to move 5% of the slower growing stuff out, as long as we focus on replacing it with some faster growing stuff.
Yeah.
Right. And I would also point out, while of course Bank of America was very much a special situation when Hugh started accumulating it, and maybe even to some extent still is, though it's, as Hugh mentioned, quality is getting better. It's kind of growing out of that situation. But if you just go by the numbers, again, the par is not terrible, but below my par. And the quality is approaching middle of the road. It's not even in the good area anymore, although just barely out of the good. So it's kind of one of those things, like we're if we're going to talk about the lower chart in just a second, where you say a little bit trust the system and trust the numbers are saying that Bank of America, in particular of these three, is one to say thank you very much and to move on.
Yeah.
And the other thing, this is something I want to tackle in a future month, and it won't be too far down the road. We've done so much house cleaning and celebrating of successful picks and that kind of stuff as we sold them. We're actually almost at the point where the net cash into the portfolio, all these $1,000 hypothetical investments, is almost at zero, and this will get us $20,000 closer to it. It's just kind of amazing to watch, and wait till you see it. I mean, at some point, some people, I don't like the expression, but some people talk about playing with the house's money. We're basically going to have, a net cash inflow to this portfolio of almost zero, and it's $400,000 over 8.5 years. It's really kind of a neat thing to think about, and we're getting pretty close. So let's go ahead and talk about the rule of 5 timeout crowd. The first two get a pass. Those are, we basically nod in the general direction of Hugh and say, okay, this is raw, rampant speculation. We get it. So we're just hoping that $2 stock takes off and goes. In a moment of disclosure, I'm pretty sure, Hugh, you own some of this company, and
I do, yeah.
My wife and I do also. And in further full disclosure, I didn't know it was down to $2. I'm probably going to buy some. I'm probably going to buy some more in my Robinhood account. So no, I think it gets a pass, and we hope for the best. And that's the one you're going to present here in a few minutes. So that'll dictate how much money I put into it tomorrow morning. So the other four companies on here are eligible for dismissal or partial dismissal, and I'll let you guys take it away. What are your thoughts?
Well, Mark, I'll tell you that the bottom three are my ideas. They're from a reasonable amount of time in the past, and the thesis that I purchased all three of these no longer holds in my mind. I just think that energy is too hard to call right now with where it's going to go, what it's going to do, and it's been extremely volatile, up, down, everywhere else. I'm not going to try to pick the high or the low for the price of oil, and therefore Schlumberger is going to follow the pack. It provides materials to the whole oil industry. It's a great company, high quality, but at the same time, it just hasn't made a lot of profits over the last 5 years. Polaris has been a one mistake after another. They've had problems with paint. They've had problems with mechanical. They've had problems with entire units of manufacture. And I'm just not sold on Polaris as a strong company going forward until they can get everything working together again. I'm also thinking to myself, looking around Michigan where I live, thinking back 15 years ago when everybody and their brother had two snowmobiles in their garage. And today I'm thinking to myself that all-terrain vehicles, snowmobiles, these types of things are maybe having the same problem that motorcycles are having. They're not nearly as popular with the demographic that's going to have to buy them to keep the sales moving in the right direction. Us older folks aren't buying them anymore. A lot of times they're just sitting in the garage up on blocks now. And so I don't have any problems getting rid of all three of those off the bottom. I'll let Cy speak to ADS.
Okay, and Ken, just a note, we're getting a little bit of breathing noise. If you might want to check your microphone position.
Okay.
Okay, and Cy, I'll just say one thing real quick here with it. Alliance Data Systems is a multiple time selection. So again, this relaunches the debate of, a single ADS position within a group of, I think it's 7. We go by the rules. We are talking about selling a specific individual lot, and it's something we probably need to talk about more. But what are your thoughts?
Well, that would be one. Is that again? If you're, what I understand, the attempt at what this relative return timeout or selling when the market is running against you or you're running against the market, whichever way you want to look at it. I understand the theory behind it, and I am all for some experimenting in both real money portfolios if you do it with just a little bit of money, and certainly in non-real money portfolios you can try things out. All of that said, I really think if you are looking at quality type determinations, which is somewhat what this is, it's a kind of a market sentiment as opposed to business quality, although sometimes they're related issue. It seems to me that it should be an all or nothing thing. The other concern that I have about this 20% relative return issue is I suspect many of our solid picks, in fact, EPAM tonight, if I had presented it a month ago, it would have, and it had been picked, let's say I had picked it in November, we would have been having this debate about it in December, and it's now back up to nearly a 52-week high. Mm-hmm. So volatility happens. And actually that is, I don't know that for 100% sure on relative return, but I bet it is, because EPAM has actually bounced around between 30 and 40% down and then back up during that time frame I just mentioned. The other thing that I would say about Alliance Data is it is if you look again just at today, a very strong buy. It's near the top of the green at about a 16.3 or so par value. It's an extremely high quality company, and the 23%, it is over the 20% cut, but it's not way over. It's not like Ardelex, which again, being a speculation, is getting a buy. But I'd kind of say that Alliance Data, unlike the ones that Ken mentioned, its investment thesis is still good, and we would still be holding on to 5 positions. So it seems to me this may be one that we want to kind of leave alone.
Yeah, and I like the idea, at least I'm reading between the lines, its presence here is kind of a flag to make sure that we're diligent with what's going on with expectations, make sure that our forecasts reflect everything. I know Eddie Elfenbein has written about some management turbulence at Alliance Data and some of the stuff that they're doing. So yeah, it's just a prompt or a nudge to dig in a little bit deeper in some cases. So I guess I'm softening on my sell the single position.
Well, Mark, I have a rule that I'd like to propose about that discipline we're talking about, but I don't know if we have time to talk about it this evening. So I don't know. You just want us to agree that what we're going to move out of this portfolio, right? And yep. I'm in favor of moving the top 3, Dollar Tree, Bank of New York, and Bank of America, and the bottom 3 on the bottom list, Polaris, and Schlumberger.
Okay, if everybody's good with that, we'll just go with that for now, and let's slate a little bit deeper discussion of the partial position question. We can cover it during our session next week, Ken, and then we can also cover it next month here.
Okay.
Sounds good to me.
All right. Just a quick audit on Dollar Tree to show that it is down in low single digits. If you actually use a 6% growth rate for expectations and margins in that 6% range, which is certainly arguable, you do get down to a 4 or 5% return. So that's just a quick audit compared to some recent value line numbers and our studies here. So with that, let's go ahead and move to our case study, individual stock selection part of the program. We'll kick things off tonight with, again, that company that performed so well for us from 8 years ago through 6 years ago, and Ken would like to revive it tonight. TJ Companies.
Thanks, Mark. Let's show the next slide, okay? I like to have a thesis when I invest. I like to have some good reasons that I can jot down in notes for why I think the company has potential 5 and even more years out into the future. And my thesis for TJX is that there are 2 kinds of people in the world. There are people that shop because they must, and they need to be forced to shop. And I think they represent the majority of people in the world. And then there are people that shop as a sport, and they're a sizable minority in the world. I think the first group of people that shop because they must are very attuned to online shopping. I think that they find it enormously convenient. They find the pricing with a single price that you can find and compare to other places online. They find that easy to do. And they don't want to be bothered by getting in the car, driving to a store, and finding what they need. The other group of people, however, those that shop as sport, I think will always be with us. I think that's part of American culture to a certain extent. And I think TJX characterizes and maybe epitomizes the perfect kind of venue where you can go to shop as a sport. TJX makes real big play of the fact that the average customer in their store visits their store more than 3 times a month. Now let that process in your mind. Not 3 times a year. The average customer in a TJX store visits at least 3 or more times a month. And they go there because of the quick turnover of goods, and they go there looking for bargains, looking for treasures, looking for things that they can discover that they never knew that they really needed in the first place. TJX turns its inventory over 6 times a year. That's comparable to Target. And TJX doesn't carry any grocery or drug items to make that turnover move as quickly as Target's turnover is. The average department store turns its inventory over less than 3 times a year. So TJX can sell twice as much stuff as the average department store as it continues to turn the inventory over. TJX is in a sweet spot right now where, with the closing of department store chains and standalone stores, there's a lot of goods out there for sale that wouldn't normally be for sale. TJX is having a very easy time right now finding goods to stock its stores, and it's buying them at really reduced prices, and it's able to pass a lot of that savings through to this treasure hunter who goes to the store 3 or 4 or 5 times a month. TJX has a lot of brands. In the United States, we're used to the top 3 brands of TJ Maxx, Marshalls, and Home Goods, but you could see that worldwide they carry a lot of different brands. TJX is putting a lot of effort right now into growing its Canadian brands, and it will be growing the store numbers in Canada from around 600 stores to over 1,000 stores in the next 8 to 10 years. So there's a lot of reasons why TJX can continue to grow, can continue to be extremely profitable, and can continue to reward investors. Next slide, Mark. Please. Thank you. This is from an investor presentation that TJX made online, and I'm just trying to show the amount of long-term potential that there are in different stores throughout the different places that we're looking. TJX International has the potential to almost double, and there's no time interval on this graph, but we see that the TJX brand can go from 4,000 plus to about 6,000 plus, and what they're telling us is this is going to be happening somewhere and they're pretty broad in where they're pointing us, but somewhere in the next 7 to 10 years. This does not reflect the extra effort they've decided to put into Canada that I just spoke about previously. Next slide. It's very seldom that I get a chance to seriously contemplate buying a company that value line rates 1 for timeliness and 1 for safety. But this is last Friday's value line, and look at those numbers up there, 1 for timeliness, 1 for safety. Remember that the timeliness rating is somewhere between a 6 to 12 month call on how the stock will do compared to the rest of the market. 1 is the highest rate they can get, 5 is the lowest. So Value Line thinks quite highly of TJX in the near term, but then look to the right, you'll see that Value Line also thinks quite highly of TJX in the long term as well. I underlined the one sentence that I thought was particularly germane to the point I'm trying to make. Value Line projects sales at around 8.5%, earnings around 13%. I collected data from a number of different sources, and the sales value that I'm getting from most of my sources ranges somewhere between 7 and 9%. The earnings number that I'm getting from my sources ranges somewhere between 10 and 15%. So Value Line is certainly in the ballparks of both of those sets of numbers that I'm talking about. And I would urge you not to use a single source to make projections on your SSG. Collect a lot of data and look at it carefully and do some thinking about where you think the number is going to come down, reminding yourself about everything you know about the macroeconomic outlook as well as the company's economic outlook. Next slide, please. This is the Chronicle, and I go here almost immediately after I start reading about a company because I want to make certain that I'm looking at a high-quality company. I would love to see a nice, boring, horizontal blue line down there on the Chronicle, but this one's almost as good. It's gradually moving up. It looks like it moved up from around 90 or so to almost to exactly 100. The current quality is 100. So I don't see much not to like about the quality of TJX. Notice that if I would have purchased this at the end of December, that last tick on the red graph, the red line graph, is demonstrating the par value if I would have made a purchase at the end of December going into January. I probably could have returned somewhere in excess of what I am going to return looking at it today, but it hasn't changed that much. I'm still going to get a pretty decent par value. I'm still looking at 11.5%. Another tick is going to be added to this graph as of tomorrow, the end of trading tomorrow. When the last day of January finishes, we'll get another green bar and another red tick to show us where the par is. This number is from a day or two ago, 11.5% par at that point. I like to take the manifest numbers and then I like to run myself through an SSG and see how close I come. Next slide, Mark. Here's what I'm using for an SSG. Make yourself aware of the note at the bottom of the page. TJX's fiscal year does not match the calendar year. So those 3 quarters that we see floating after the end of the 2017 year, they began in January 2018. In other words, all 3 of those quarters are under the brand new Tax Cut Jobs Act. I have the wrong acronym there. I think it's TCJA. But all 3 of those quarters are going to be under the new Tax Cut and Job Act. So I'm going to be able to read what kind of taxes they've been paying for this fiscal year, and their entire fiscal year, which will end tomorrow, will be under the new Tax Act. That's going to be important because it'll be the first companies, one of the first companies, where I get a true read on what total taxes are under this new environment for a typical retailer. Next slide. I ran my SSG. I used 7% sales growth. That's considerably beneath the 8.5 that Value Line was indicating. I used 11% earnings growth, again, beneath the Value Line number of 13.5. I came up with an average PE value of about 18.5 that I used on this SSG. That goes through all the arithmetic, and I get an upside downside of about 4-to-1 with a par value of about 11%. Remember that Manifest, I think, had a par value of 11.5%. So I'm certainly in the same ballpark. I'm getting validation for my own SSG, and I think it's extremely reasonable, the numbers I've chosen. If there's going to be a little bit of error in my numbers, I think they're probably because they're slightly too low rather than too high. Next slide, please. So I'm going to suggest that we put TJX back into the portfolio after an absence of a long time. What, about 10 years? About 8 years absence in the portfolio. Let's put it back in and see how it does.
It's a great
Mark,
company.
what's this slide here talking to us about?
Well, first of all, if I've been in TJ Maxx 3 times in a lifetime, what kind of a shopper does that make me?
Well, definitely the other kind, the majority kind.
I'm not going into TJX for sport, huh? Well,
No, I don't think so.
it's just a quick reminder that next month's program will be our annual awards program, and we've had a lot of fun with this over the years. We talk about, we just take note quickly of what the best all-time selections have been and the selections within a given year and that sort of stuff. Kim Butcher kind of hogged all the awards last year, so we're hoping to give her some competition again this year, but that's what the Golden Knights and the red carpet are all about, so you might want to mark your calendars and be ready for the note from Natalie. So with that, I think we'll turn up the heat and invite Atlanta into the conversation with his repeat selection of EPAM systems.
All right, thank you, Mark, and I'll try and keep this reasonably quick since it is a repeat selection, although it's been about a year and a half since we've last looked at EPAM. This is the intro chart, fairly decent up straight and parallel lines, and you would notice that the history only goes back to 2010, but EPAM has actually been around since 1993, so it has been public going on 9 years now, but it is a much older company, yet still relatively small and nimble. Next slide. I came up with EPAM by taking a look at the portfolio. I knew we were going to talk about those orphans, and I've given just some anecdotal thoughts to Ken's talking about how we should perhaps double down and triple down a bit more on some of our picks and could do better over time with some of them. And here's what I came up with, just ranking by par. You see 2-6 is still a pretty good candidate. I've picked that the last 2 months. And then down a little further, Simulations Plus and EPAM Systems looked like candidates as well. Next slide. I then ranked by growth. Again, Ken's talked about how we would like to boost the portfolio growth a bit. So I said, well, let's take a look at the companies by growth. You see here, EPAM comes up to the 4th position and is actually the only high quality, that being excellent quality company that is currently, or I should say the highest ranked by par and growth company that's excellent, as well as in the sweet spot or in the green for par. You notice Amazon would also, on this particular chart, would also be a slightly slower growing candidate, but also is in there. And then I just pointed out that EPAM is only a 3-time selection, so it's not an orphan, but it hasn't been picked as many times as Cognizant, so I hopefully won't take quite as much abuse for picking it tonight. The other thing that I find interesting about it is just under 2 years since the first pick. It was February of 17, and then I reselected it in March of 17, and then I believe maybe October or so of 17. It was later that year. Those 3 picks have nearly doubled in value, so it's certainly got some tailwinds behind it as well. But notice the forward-looking aspect is good too. A little bit of what Ken was talking about with his one on a value line. That value line is picking something that has some momentum and some near-term prospects as well as long-term prospects. This one has some past performance return behind it, as well as still looking good going forward. So I decided I'd do EPAM. A couple of other checks just to see. Next slide. I did a quick industry study, and again, EPAM actually is the only company in the info and technology services industry that has both excellent quality and a green PAR. You see there's only one other green PAR company even though I have taken out some middle. You can double check me after the session tonight if you want, but Edgewater Technologies is the only other green company, and you see the the quality is somewhat low. So EPAM looks good from a industry standpoint. Next slide. I did just a quick stock search as well, taking a look at minimum 14 PAR, a little under EPAM's PAR at the time. I went ahead, cut it off at 20. There were a few companies that would be up in the yellow with that screen, but an excellent quality and a 70 financial strength, which again, kind of a minimal financial strength. Given current market, I kind of prefer an 80 or higher for financial strength. But for this screen, I opened it up a little since I was dealing with high growth companies. And again, you see there's only one stock in the manifest universe, that being Align Technology, that has a higher growth rate with that level of quality. So all of those things said, looks like EPAM is a solid pick for tonight based on looking for something that's high growth and high quality with a good PAR potential. Next slide. This is the company. They're an IT company. Their heritage is in software engineering. And it actually was started in 1993 by a pair of Belarusian individuals who grew up in Belarus and had met in elementary school, and one of them was here in the United States going to school, and his friend was still in Belarus, and they started a multinational global company with in their two apartments between the two companies. You notice it's one of the fastest growing public tech companies. It's been on the Forbes 25 list a number of times. In the last decade, it was most recently ranked 12th, and also is on Fortune 100 fastest growing companies. Most of the rest of this slide we'll see highlighted in a couple of other slides. Next slide, Mark. This again is just kind of a graphic summary of the company, founded in '93. You see the 5 primary industries that they operate in: financial services, travel and consumer, software and high tech, business information and media, and then life sciences and healthcare. And then there is a branch that they just call emerging, which are their new customers and new areas that don't fall into the others. Notice geographically their revenue is mostly North America, with about a third coming from Europe and then a smattering from developing and Asia Pacific companies. Next slide. EPAM is unlike Cognizant and some of the, and Emphasis as well, and some other engineer or software IT outsourcing and consulting companies. Their labor force is primarily in Europe, principally Eastern Europe, Russia, Ukraine, and Belarus, as you can see, and the majority of customers are in North America, primarily the United States. Next slide. Next slide, please. Here we go. And then here are the, again, the 6 areas they break down their business in to include the emerging. I've just highlighted in green the fact you could see of financial services. They work with 5 of the 10 largest investment banks, largest online travel association and hospitality company, 4 of the top 4 broadcast networks, so all 4 of the major broadcast networks, and 14 of the top 30 of all TV networks they work with. And then in life sciences and healthcare, 9 of the 10 top pharma companies. So their quality, they have a very high quality customer base. Next slide. This just shows their services and how they have worked from the base of product engineering. I mentioned that software engineering was their background and what they built, and you see, and then they've added technology services, product development, and then most recently platform engineering over the years. And you could again see how each of those competencies, they call them, diversify the company's base. And then again, you just show the percentage of revenues and how it's developed over time over those 6 areas again that we saw in the last couple of slides. Next slide. This chart simply shows that, again, they have a good diversified client base. Their top 5 clients have been with them on average 11 years, top 10 for 10 years, top 20 for 8. And you could see if you move from 2013 through FY 2017 in that the bar charts right there in the middle of the page, you could see that they're becoming a little bit less reliant on certainly the top client, but even the top 5 and then top 10 and so forth. So again, they're diversifying their client base somewhat, although you can see that even though even their top clients have a solid longevity with them. Next slide. This simply is the front page of my stock selection guide. You see significant high growth. In fact, historical sales growth in excess of 30%. I used the projection of 20, which is also the manifest growth projection, I believe. And you can see the projections out the next, 2018. They will be concluding the FY, or reporting, actually, they've concluded the FY 12/31, but they'll be reporting February 14th, I believe, 14th or 15th, they're reporting their annual sales. And you can see the value line projections for 2018, 2019, and then out in the 2022 timeframes, which are roughly in line with my projections. Next slide. This is the Eagle format off of Manifest Investing, 20% growth rate, net margin of 11.5, which is right in line with current margin. Value line is projecting margins to increase somewhat over the 11.5%, but I chose to be pleasantly surprised. Again, PE ratio, I'm forecasting a little bit of a lowering of the PE over time, because the company has, as we've seen, has some momentum behind it. Interestingly, the biggest difference, I mentioned global payments earlier tonight. Value line rates EPAM as a 2 for timeliness. So they see some near-term advantage to EPAM, but they are not particularly optimistic for long-term appreciation. And the reason is Value Line, for some reason, and I have no idea why, is projecting a long-term PE of only 20, compared with the historical on Value Line PEs running in the 30 to 40 range, as well as the growth projections of Value Line and margin are right in line with mine and with Manifest's projections as well. So I don't know if that's a mistake on Value Line's part, that it's a typo that somehow has gotten in there and has worked through their figures, or if they just have an extremely pessimistic view of the company. But I thought that was somewhat interesting. Manifest consensus, however, is around the 31, which is what I'm using. Also, you see that gives us a projected return of 12.4%. With some room to be surprised. My SSG high return is 14.6, and manifest consensus par is 15. So I say let's add a fourth position in EPAM.
Okay. Thank you, Si. All right. While Hugh gets warmed up, just wanted to make another quick 15-second plug for this year's contest. The 2018 version will come to an end this coming weekend, and we'll crown our champions. But if you would be interested in participating either as a group or as an individual, it's really just a matter of selecting 5 to 20 stocks. Choose carefully, choose for the long term, send them to me. There are no transactions during the year. Dividends are included, and the winner is whoever has the largest number exactly 1 year from Groundhog Day, which is this coming weekend. So with that, let's go ahead and go to Pasadena for our Ardelyx and an update on one of our friskier stocks in the tracking portfolio.
Yes, indeed. And, I always warn people that this is not really investing, but kind of in the spirit that Mark was talking about earlier, where we kind of used our profits to pay to develop this $400,000 portfolio. We're always there, almost there, I should say. What I do with these biotech companies when I buy them, and not all of them do well, but those that do well do really well. And I then use those profits to buy quote-unquote real companies, the boring ones that will put people to sleep. I was going to put a few charts on here, but then I think, listen, I don't want any pretense that this is on par with what we just listened to, the quality companies that we've talked about. So I'm just going to run through some of the news that's happened with Ardelyx, why I still think it's worth looking at, and again, not an investment, but for people who like to put 1 or 2%, maybe 1% into something that is highly speculative in the portfolio, it's always a little bit of fun, So all else been equal, I tend to like to buy companies that I own already. Maybe it's a sign of weakness, who knows? But that's what I've always been doing. And maybe I'll just add 1 or 2 new companies a year, but I like to buy what I already know because I'd be looking at it constantly. And as long as everything is fine, I'm quite happy if the stock price drops because I'll just buy more. I've always kind of enjoyed saying that you really have 2 portfolios, the one that you own and the one that you want to own. And they're always in conflict. So when it's a good time to own, it's not a good time to buy generally, and vice versa. I look for companies that are at a low, because again, lazy. It helps pull out some of the downside risk. And for a large company, I generally like to have a 52-week low. If it's a medium-sized company, maybe a low over 2 or 3 years. And for a tiny company like Ardelyx, thanks to the recent crash in the stock price, it's getting tinier. But I like to get it near a 5-year low. And I think this is the 3rd time in 2 years or so that I'm buying it at a 5-year low. The first 5-year low was at $10 or thereabouts. And then it dropped to just under 4, so bought some more, and now it is hovering around $2. It stops at 0, but I don't expect it to get there. So let's skip on, and I'll just talk about Ardelyx. Again, it's not an investment, but it has a promising story and a lot of recent good news. And I'm not aware of any emerging pharmaceutical company that ends up with an approved drug if it's what's called a new chemical entity, a novel drug, which is what Ardelyx is working on. I'm not really aware of any that has fared badly. Stock price certainly would have gone 10, 20x, but sometimes they're bought at 2 or 3 or 4 times what they were when they first filed for their new drug application. So I'm hoping that most of the bad news or downside has really been pulled out of the stock price. It's now at a frightening $2 a share. It was at close to $4 when we last spoke. So let's skip on. It is a clinical stage pharmaceutical company, which means it doesn't have any product, so it's not taking in revenues. And its earnings, as people like to say, are negative, as that means that it has earnings, but it's bleeding cash. It's a small molecule company, and it works on novel targets in the digestive tract, which is an area of a lot of research right now. Quite a lot of the cells in our body are actually visitors. They're life forms living in our body in the digestive tract working away. It has 3 programs. We'll look at the pipeline in a second, but tenapanor is the one where a new drug application, so the company does clinical trials, phases 1 through 3, puts all the information together in thousands of pages of documentation, and asks the FDA for permission to sell this drug through pharmacies. That's a new drug application. It's called a biological license application for a large molecule. But an NDA is submitted, and that word should be "and accepted," because it has been accepted by the FDA, which means that they haven't found any flaws in the actual submission. It's not a judgment as to whether it's a quality submission, but all the T's are crossed and the I's are dotted. And it means that the FDA will review it, and they will likely make a decision by what's called the PDUFA date, which is generally 10 months after the submission. So that would put it at July 13th. It has 2 earlier programs, RDX 11 and 13, and it's a public company, obviously. But if we skip on to the next slide, we should, a little bit more news. It released results of clinical trials of its lead drug since we last spoke in October, or September rather. It's administered this drug to over 3,000 patients, and it's a first-line treatment, the first treatment to control phosphate levels in the blood. And this is particularly problematic for people with end-stage renal disease, people on, well, it's actually a very common issue, but they are expanding it into IBS, pain associated with that. They have another clinical trial we'll see in a second. And as I said, the likely PDUFA or decision date by the FDA is going to be around July 13th. And because this is a novel drug, it's got a novel, what's called a mechanism of action. No other drug has done something like this before. The FDA will almost certainly refer it to an advisory committee. And the advisory committee meetings are very interesting, and I'll alert everyone when it's going to happen, because they publish a document in advance, and that's a real telltale sign of whether or not the drug is likely to be approved. It's also quite informative because it's a summary of the hundreds of thousands of pages submitted to the agency by the pharmaceutical company. The PDUFA is a Prescription Drug User Fee Act. It's an act that's been around for 20 plus years now. When the FDA asked Congress, why don't you charge pharmaceutical companies to file a new drug application, and then we can use those funds to hire reviewers and expedite the entire process, because there was a time when it could take years for the FDA to review an application, but they've really sped that up, and they will give expedited review in some cases if it's really an important drug, and they can review it in 6 months. But the FDA, for some drugs that are really breakthrough therapies, they've reviewed applications in 1 or 2. But the typical length of time is 10 months from submission of the new drug application. So we skip on. The financial position of the company is good for an emerging pharmaceutical company. It has almost 200 million in cash. It's burning through, about 23, 24 million a quarter. So it has about almost 2 years of cash on its balance sheet right now. And if tenapanor gets approved, it's likely to trigger a funding event, or the company actually just could get acquired. Let's skip on. Again, this is the pipeline. As you can see, it's a quite healthy pipeline. But the lead, it's critically dependent upon the success of this lead program, tenapanor. It's being filed for the end-stage renal disease hyperphosphatemia, which is right up at the top. They have filed the drug. They filed the application for that indication. They are working on a second indication for irritable bowel syndrome, pain associated with that. And the other 2 programs, RDX 011 and 013, are in the what's called the IND enabling phase. Investigational new drug is an application to the FDA to administer a drug in humans in a phase 1, sometimes a phase 1/2 clinical trial. And they're doing the studies that will allow them to file this document with the FDA and hopefully start doing phase 1 trials. I think it's this year. Let's skip on. And this end-stage renal disease, the elevated levels of phosphate in the blood, is a problem for people with kidney disease. There are not any good treatments for this. I mean, people have done kidney dialysis, blood transfusion at an extreme, but often modifying the diet or taking antacids, particularly calcium carbonate. Calcium complexes out the phosphate and can lower levels that way. But tenapanor is a therapy first therapy actually, that manages this disease that's not a binder. So it is quite novel. And they will publish some clinical trial results from the phase 3 result where it was administered in addition to another drug. They'll publish those by the end of this quarter. So fingers crossed that those will be not part of the FDA submission, but just more information about where they're going with this therapy. So we'll skip on. What I wanted to do here was I tracked funding for companies for many, many years. And this chart, if you will, shows the amount of money that was raised in 2018 that I discovered. There's certainly a lot more out there. And this not only includes venture capital funds that are put in early, the A round, B round, C round, sometimes venture round, they're called venture round, but it also includes acquisitions of a company. You can see in 2013, companies in general raised almost $280 billion, a big chunk of change, but that was one or two major purchases in the market. But generally between 10 and 30 billion get raised every year. And I discovered 42 new small molecule companies created last year. That's a lagging indicator because it takes me a while to find them. So that number is probably by the middle of this year going to jump up to about 60. And of course, there was a big influx of new companies in 2015. And on the next slide, I just want to show you the fade. I mean, if I tracked funding since 1990, the A round, which is the very first round where a company might get $1 or $2 million. B round, they will typically get between 10 and 50 million, and the C round, it can be 50 to 75 to 100. For large molecule companies nowadays, the C round can be as big as 200 and 300 million, 400 in some instances. Big change. But you can see for early companies, there's been quite a hefty amount of money poured in there, about 50 billion or so dollars. But the big thing to look at is the bottom line, the acquisitions. Major pharma has spent almost $750 billion in the last 30 years buying small companies. That's where you get your return. I think I just emphasized it on the next slide, and I've highlighted the thing in red. That's the exit strategy for most companies, even if they don't say it. They want to be bought by big pharma because they get a big payout. I have a good friend that I've known for many, many years, joined a startup years and years ago, saw his shares dip as low as 82 cents. But when they were acquired at $256 a share. He retired young, a very happy man, bought a very large ranch in California. So my guess is he didn't do half badly out of it. But they pay a lot of money to bolster their pipeline. Major pharma pays a big chunk of change. So let's skip on. And again, I'm just re-emphasizing the fact that these emerging companies in general are building an exit strategy, not a pharmaceutical company. They want to be bought. And acquisition has been the ultimate fate of most of these companies over the years. And big pharma really has outsourced drug discovery / development to the smaller guys, because they're more prepared to take certain types of risks. And I think there's a very high probability that Ardelyx will end up in the portfolio of a major pharmaceutical company within the next year or two. It's the fate of everyone, really, who has a drug that's halfway successful. And we'll move on. I just wanted to recap what we talked about a couple of months ago. If we look at the funding rounds, the earlier funding rounds for Ardelyx, they had some very high caliber venture capitalists pour money into these companies. New Enterprise is a big deal, as is Amgen Ventures. They invest in a bunch of these small guys. And they've been sticking with this company as well and putting more money in. We're actually the nice thing about getting acquired by a major pharmaceutical company is that they are phenomenally good at marketing a drug. Small guys, not so much. because they just don't have the ability to do that. So Amgen is an example of a company that can buy a small molecule and convert it magically into a billion-dollar drug. They've done that once or twice before. I'm not saying Amgen will buy this company, but who knows? Let's move on. Ending this segment right now, but I'd like to check if Ardelyx is following the script that it's outlined for investors over the last number of years, and it certainly has. It's followed through on everything it said it's going to do. Developing a drug, successful clinical trials, filing a new drug application, and the FDA has accepted that. And the clinical trial results recently have really been very good. More things are coming out in the next few weeks. So as I said, all indications are that Ardelyx has a drug. It's just up to the FDA now to see if it's approvable or not. And we'll know that in the middle of July. As we skip on, I think the next slide is the very last one. Yeah. So the stock price is depressed, and I frankly, I'm surprised at how low it has gone. It has good clinical results. It meets all its endpoints. It has quality investors that kicked the tires of this company early on and have bought into it. And it now has a new drug application accepted by the FDA. So everything seems to be coming up roses. The big imponderable is the approval by the FDA, and that will make or break the company in the next 6 months or so. The price continues to tank, but I'm hoping it has bottomed. I do think that it's time for me to buy more of this. And that's what I want to do. I like Ardelyx. So I hope I haven't scared you. Maybe Mark will reassure you with his pick coming up next.
Not scared. I do find it interesting that Rock Springs and Chris Jenner are on that list, and we've talked before about how it reminds us a little bit of Aguron Pharmaceuticals back in the 1990s, and that actually did pretty well for people. All right, we're running a little bit late, so I'm going to go ahead and give the 2-minute warning, lightning round version. This will be a really quick one. Health insurance innovations. It's a dramatically important field of opportunity for a number of companies. This is a company that has kind of burst onto the scene here in the last couple of years for reasons that you're going to see in a minute. But I mean, this all comes down to the big healthcare challenge and how this stuff all fits together. This company was actually featured several months ago as Fortune's #1 fastest growing company. It was brought to our attention by a few of our subscribers, and we put out the list, and we tracked these type of companies. Ken and I included it amongst our best small companies for 2019, despite the fact that all that publicity had run up the price a little bit. Well, I'm here to say, well, some of that bloom has come off, and it actually did sag back a little bit, giving us the opportunity for patient positions and accumulation. What it really boils down to is these guys are world-class technology, and they help with all of the processing, things like putting insurance and benefits administration right on your cell phone or at your fingertips, and streamlining the logistics of figuring out who needs what at what type of optimum pricing. You know, whether you're a 24-year-old person, you have different healthcare needs than an 84-year-old, and they basically are tailoring and optimizing and, in a nutshell, making customers happy. Doing the insurance thing with fewer complaints and just a much higher level of execution. That's what these guys are about. So we will continue watching them. We'll probably have more about them. This is actually a slide from their investor relations page. You can go and take a look. They're partnered up with companies like Chubb and Nationwide and others that really give them a lot. It's a tremendous field of opportunity. It's all about making customers happy, giving them optimum solutions. A very scalable company. You know that I love that word as it applies to some of the South American ventures we've talked about and that type of thing. But a scalable company just means that the potential for dramatic profitability expansion exists. And here's a quick look at the company. Again, fairly sparse data, relatively new company. Again, on that Fortune fastest growing list, you can see that they have been around for a few years, trading for the last 6 or 7 or so. And they are emerging from that early life cycle position, and they will be heading for some type of a more early stage profitability. Most of the people that follow the company as analysts believe that will be somewhere in that 15% range for profitability. That is quite feasible and achievable. So you're talking about a company that has a good field of opportunity, growing at 18%, bringing home, 14, 15% margins, with a PE ratio that certainly seems to belong in the 20 range, 20 to 25 range for a company at this stage in its life cycle. So under current conditions, again, the stock price has come back from that furious wave of attention that it got after the Fortune appearance. But now we're back to a price in the mid 30s with a projected return somewhere in the mid 20s. So I'm going to go ahead and add it. We'll probably come back and take a little bit closer look at their specific hooks and niches that they're exploiting and what they're delivering. But I'm going to go ahead and add HIIQ to the roundtable tracking portfolio for now. And that's the 2-minute lightning round version, but again, a very important area. And Ken, I think we can go ahead and run the poll. If Ken is still with us, you didn't start on your adult beverages already, did you, Ken? You probably are muted, Ken.
The poll is up, ready to be voted on there. I see a lot of you are voting already.
And we're actually deciding who's going to be tonight's orphans.
I'm going to close this down. I'd like to get to 90% if we could. So if you haven't voted, just take your mouse and pick one. As simple as that. We don't know what you chose.
But we have ways. No, I'm kidding.
And I'm going to close the poll and share the results.
And I'm guessing it's TJX. I can't actually see the poll.
It is TJX at 42% and EPAM at 28%, health insurance at 17%, and 11% of us are out there speculating with Artilex. Okay.
Wow, that's pretty frisky.
Yeah, that is large.
Yes, it is. I'm going to hide the results of the poll. And Mark, you want to show folks what we have coming up here in the near future?
Yeah, we've got some coming attractions. Ken and I will be doing a session, I believe that's in a week, certainly talking about groundhog, talking about better selling, and a couple other topics that people have brought to our attention. You can see the various locations that Ken, Cy, Hugh, and I will be at. And Kim will actually be joining us at the NAIC National Convention in Chicago in May, but we are making stops in Sacramento, Chicago, Pittsburgh, Traverse City, and Atlanta with a few others thrown in, but we will be expanding that list. And
Mark, since we put this list together, we have a date in the middle of August in Oklahoma City as well now.
That's right. I'll get that on the list then, and we will be fine-tuning this a little bit.
Okay, I'm looking at our. Go on, Mark. You have something to
Just one last,
say while I
one last plug
question?
for the groundhog. One last plug for the groundhog.
Why don't you tell folks exactly how they can enter that contest again, Mark?
Yeah, we've just had a wonderful time over the last several years, and again, I'll go back here to the slide that covers it. Anybody anywhere in the country can actually send their submission, selecting a minimum of 5, maximum of 20. Frankly, I'll tell you, the people that tend to do better are in the 5 to 10 range. 20 generally is going to get you closer to market performance, and that's not bad, but that's generally been our experience. But you can send them to that email address, or you can post them. If you're a Manifest Investing subscriber, you can post them in the Groundhog Challenge folder on our forum. But again, the ground rules are basically there won't be any transactions. We do account for dividends, obviously stock splits. We do not do penny stocks, but those are the only rules. And Everybody's invited to participate. We'd like to see clubs from around the country, and it's always been kind of fascinating to see the ladies out of St. Louis have won the contest 3 times. They have a fantastic track record. As we mentioned, Anna from Holly, Michigan, just seems to have the golden Midas touch here, at least for the last few years. Hughes won the contest a few times. Nick Strategos has been part of winning it a couple of times. Many of the people that you see here at the round table have had pretty good success with the contest over the years. So again, that invitation is open, and you've got from now till Monday to do it. And again, choose. Our experience has been the people choose not just with, as Ken and Cy both mentioned tonight, the next year in mind, but the long term. Generally pretty high quality stocks and investing fairly strategically, even though this is a contest. We pay as much attention to the results over 12 years as we do any single year. So it's a lot of fun.
Mark, can you go back to our coming events slide?
You betcha.
And I just want to note that in April, my own chapter and the Southeastern Michigan chapter will be running an event, and we'll make sure it's on our coming events going forward. But if you need information, the date is April. I'm going to look at the calendar to make sure I don't tell you incorrectly. It's April 13th, and it'll be held at Baker College in Flint, Michigan. So we'd love to have as many Southeastern Michigan people there and Mid-Michigan people as we possibly can. It's a joint venture between our 2 chapters, and of course we invite folks from all over the state and from Northern Ohio, Northwestern Indiana. Come on up and join us for a great day of investing. Rod and Ann, come on down and we'll recognize you in the audience for being true groundhoggers, okay? Other than that, Mark, I've cleared the question box. Okay. I usually say that, and then something happens and stuff comes up. But right now, we're getting just thank yous, that kind of thing. So I want to say a big thank you to having all 4 of the original Knights with us this evening. Big thanks to Hugh. Big thanks to Cy. And as always, Mark, we can't do this without the things that you do for us. So you're greatly appreciated.
Hey, it's minus 20 degrees out there. What else am I going to do today, you know?
Good night, everybody. Good night, audience. And we'll hope to see you on the 5th, okay? Bye-bye.
Good night, all.
Thanks, everybody.